Welcome to the Professor Lending Institute, where we make sense of housing economics and the home buying process. I'm Jordan Steffaniak, president of Professor Lending, licensed loan originator, and your home buying professor. In today's episode, I'm going to be covering the topic of seller credits. So this is a common question that comes up when I talk to especially first-time buyers, but even repeat buyers who don't have experience with this. They have questions and they don't understand exactly how everything works. So I want to lay out just a little bit of the background on what they are, how to use them, how to leverage them the best. Because at the end of the day, what I try to do as a loan originator is leverage the financial transaction of buying a house as best as possible to benefit the buyer. I want them to get the best possible deal, the best possible scenario. And so what you need in a loan originator is someone who understands all of these different financial sort of tactics to make sure that you get the best scenario for you. Not all loans are the same. They're all structured a little bit differently, and using seller credits to your advantage can make a big difference in your monthly payment as well as your cash to close. So let's go ahead and talk a little bit about that. Before we do, remember, like the video if you enjoyed the content, if it was useful in some sense. Drop a comment if you have any additional questions on this, and we can do additional videos to help you. So let's go ahead and get started. What is a seller credit? Basically, all that is when you're buying a house, the seller is going to offer a sort of a legitimate credit towards you at closing. So instead of there's several reasons this would happen. One common one is you get a contract on a house, you have an inspector come and do an inspection, you find something that's wrong. There's something wrong with the sewer, there's something wrong with the foundation, whatever it is, and it's a $15,000 repair. You get somebody come out, look at it, say, hey, it's this much money, and then you negotiate. And they basically say, okay, we're going to keep the sales price at 300,000, but we're going to go ahead and give you 10 grand as a credit at closing that will go towards your closing costs or other things that you can then use towards a repair once you buy the house. Or it can be an incentive for a seller to try to attract a buyer, right? So in markets where there's a lot of houses on the market and not as much demand, they may say, look, $300,000 sales price, but I'll throw in 10 grand to cover your closing costs. And that can entice a lot of buyers to potentially pick that house over others, as well as it could potentially help a buyer qualify for a house. So in some cases, especially first-time home buyers, they may not have enough cash to be able to cover the closing costs. They can qualify for the mortgage, but they just don't have $10,000 liquid or $15,000 liquid to cover all of the total costs in order to purchase the house. So they'll offer this incentive, and maybe they negotiate it to where instead of $300,000 sales price, it's 305. We're going to offer $5,000 of closing cost assistance to cover the closing costs, and that way you don't have to bring as much to closing. Because remember, when you're buying a house, the cash to close figure is going to include the required down payment and then the closing costs. So closing costs are additional things like the appraisal fee, setting up your escrow account of your homeowner's insurance and your taxes, the settlement agent fees for the actual closing, paying the closing attorney. Those sort of things are all fees that are associated that are separate from the down payment. First-time home buyer, 3% on a conventional loan. Repeat home buyer on a conventional loan, 5%. Seller credit cannot cover the down payment. So there's no way around it. You got to have the down payment. If you have a VA loan or something like that, you can go up to 100%, and then you get a seller credit that can cover closing costs. You could theoretically bring nothing to closing on a VA option, but we'll get there in a second. So let's just go ahead and mention a couple of rules when it comes to seller concessions beyond it can't cover the down payment. So it can only cover things like, loan origination fee, discount points, appraisal fee, inspection fee, title fee, recording fees like property taxes, those sort of things it can cover. So anything that goes under the bucket of closing costs, it just can't go towards your down payment. Now, there are also additional rules where, depending on the amount of down payment you have on a conventional loan, you're going to be capped at how much of a seller concession someone could have. So they can't just raise the sales price infinitely and then give you $50,000 worth of a credit. That's not how it works. So if you have less than 10% down on a conventional loan, you're capped at 3%. If you have up to 25%, but greater than 10, but less than 25, you're capped at 6%. And then beyond the 25 mark, you can go up to 9%. On an investment property conventional loan, it's 2% no matter what. Doesn't matter how big your down payment is, 2% is the cap. So I run into this oftentimes, especially with investors who are purchasing townhomes or different things, and they're purchasing primarily for cash flow. Oftentimes they're a little bit dated, older homes, and there's going to be issues that are uncovered with the inspection. They'll negotiate a sort of seller credit, but we got to be very careful. 2% is not a lot, so you just got to think wisely about how to use that. FHA is going to let you go up to 6%. VA is going to let you go up to 4%. USDA is going to let you go up to 6%. So lots of opportunity there. But let me sort of walk you through like why a seller credit is more advantageous for you as a buyer than is a reduction in the sales price. So I'll go ahead and share my screen. This is just a simple little Excel piece that I put together. So literally this is just a simple Excel calculator that I put together here. So scenario 1, scenario 2, let's say it's conventional loan, say it's 30 years. Let's say the home value's $300,000 across the board. So as it stands, before we do anything with seller credits or down payments or closing costs or anything, or the interest rate, you're looking at uh, on a $300,000 loan, if you were a first-time home buyer, right here, 3% is $9,000. So you'd have to bring not only $9,000 for your down payment, let's put that in there, but your closing costs are probably going to be about 9 grand. That's just a total estimate. So I'm just using 3% of the total home value here, the sales price. It could be less than that, it could be more than that. Oftentimes this is just a good estimate for illustrative purposes. So in this case, you have to bring $18,000 to closing. So what could happen is like, hey, I don't have $18,000, I only have 10. What can I do in the situation to buy the house? Well, if you can find something with a seller credit of $10,000, look at that, your cash to close goes down to 8,000. Okay, that's great. Okay, 300,000. But here's why it's more advantageous, because you could say reduce the sales price by 10,000, and yeah, your loan amount's going to go down by $10,000, but you're still bringing about $18,000 versus $8,000. So for somebody who needs to keep money in their pocket, and let's just say it's 6% interest rate, yes, your monthly payment's going to be in this case about $60 cheaper a month. Okay, but you got to keep $10,000 in your pocket. And if you didn't have that additional $10,000, that's a big win. Now, here's the other thing you can do in this scenario. Let's say you don't want to bring all that cash to close, like you're fine. So I'm going to get rid of the formula here and just say it's 18,000. Cool. So in this case, you're fine with this, but here's what you're going to do. Instead of letting the seller credit cover something like the closing costs or the traditional closing costs, you decide I want to use it for discount points. Discount points are simply just paying down the interest rate. There's different fees associated with the interest rate. I've got a whole episode on this, video on this. You can go check it out. I'll try to put a link somewhere around here. Click it, watch it. It shows you how rate sheets work. Essentially, you could say, okay, I want to use that $10,000 to buy my interest rate down to 5.25. So now, look here. The loan amount, yes, is $10,000 more on the loan amount, but you're getting a $10,000 credit that's paying down the interest rate to 5.25. So in this case, sales price 300, sales price 290, you're getting a credit here for 10K, nothing here. Loan amount smaller, loan amount bigger, but you're getting a lower interest rate. And see what that does to your principal and interest? It's about $80 cheaper a month doing the same amount of money to closing, 18 grand on both cases. You're not changing that amount, but look at the interest savings. You're going to save about 5 grand over 3 years. You're going to save about 8 grand over that 5-year period, and then 15 grand over the first 10 years of the loan. And if you extrapolate it over the full period, you're saving 130 grand ish. So you can see how leveraging a seller credit can be advantageous to you. So really the value here in doing this is if you are a buyer in a buyer's market, instead of asking them to reduce their sales price, ask for a seller credit instead, because that can save you money either on your monthly payment by using that credit to buy down the interest rate, or by simply keeping more money in your pocket. So there's different ways to slice this, and to whatever makes the most sense for you as the buyer, what is the most useful thing for you. But this can save you either cash in your pocket, or initially up front, or cash in your pocket in the long run over the life of the loan. Because another thing that may happen is maybe there's a reason for a seller credit in a situation where there's no real estate agents in a transaction. And so you're trying to negotiate, like, how do we split this benefit by not having a real estate agent in this transaction? Well, in this case, the seller's getting all the benefit if there's no real estate agent, because they're the ones who would traditionally pay for both the listing agent and the buying agent's commission, 5%, 6%, total, whatever that is. So how can we split that sort of and make the best of it for both of us? Well, you can offer just simply a seller credit, sell the house for $300,000 and give $10,000 of it towards a seller credit to cover closing costs, so they don't have to bring as much to closing, or they can buy down their interest rate, whatever it is. Or, you could theoretically, raise the or reduce the sales price a little bit, but I think in terms of financial leverage, the seller credit option is always gonna be a superior than is reducing the sales price. Now, reducing the sales price is not a bad thing. Like, obviously, you can, like, in that first way we did it, if we go back and enough, maybe it's in there, somewhere in there. I don't remember where it is. You can rewind back in the video, but essentially, you're going to save some money if you lower the sales price, sure. But it's more advantageous in most scenarios to take the seller credit instead of reducing the sales price. And if you have a good real estate agent, they should understand this, and they should be able to negotiate this and do this pretty frequently. So hopefully this is a little bit useful for you guys, so you can understand the concept of seller credits. Obviously, most people don't buy a house every day. They buy it every 5, 7, 10 years, whatever it is. And so this isn't something that's top of mind. So hopefully this is going to be a useful resource for you to understand, give a little refresher, and give you some sort of educational content so that you can then make the best decision for you and your family.